Hello everyone and welcome to today's Mondac webinar in association with Kinship Law to discuss the Spanish tax regime amendment for Inpatriates. My name is Dan Sampaio and I'm joined by a wonderful panel to take us through today's discussion. Alvaro Checha is co-founder of Kinship and partner specializing in international taxation and private clients. He has extensive previous experience from his work in prestigious international firms. Pedro Fernandez is co-founder and managing partner of Kinship. Coming from an international law firm, he has 30 years of experience in the world of law with a special focus on international taxation. Regis Maloney is a vice president within the Goldman Sachs Family Office Wealth Strategy team in private wealth management based in Madrid. He provides wealth structuring services to clients and assists family-run companies and wealthy individuals. Now, before I hand over to the panel, a housekeeping item. You're able to submit questions to our panel by typing them into the control panel of the toolbar on the right-hand side of your page, and we'll endeavour to answer as many of those questions as possible. It's now my pleasure to hand you over to our team to begin. Thank you.
Thank you, Dan, and thank you everyone, every attendant for being with us today on a Thursday afternoon. When we talked to Mondac about doing this webinar and we had to choose a topic, we thought, Alvaro and myself thought that this would be clearly the topic for the day. Spain has introduced last year, towards the end of the last year, a couple of important amendments to its tax system within the space of high net worth individuals and private clients. One relating to wealth taxes and the new solidarity tax, which was in a sense contradictory to this second one. The first one that deterred some of the people who were considering to move to Spain. They sort of withdrew the plans, seeing the action that was taken in that space in the wealth tax, but at the same time and without much publicity, our special tax regime for Inpatriates, well known in the market as the Beckham regime, was amended and enlarged in its scope. It was fairly widened, and we think that these amendments bring Spain back to the cohort of countries that are somehow competing for the international mobile community, be it high-skilled workers, digital nomads, or most notably high net worth individuals and their families. And the purpose of today's webinar is to take you through this special regime, the changes that were introduced at the end of the year, and discuss some of the elements that unfortunately are left with some degree of uncertainty. And let's see if among all of us professionals involved, we can bring clarity to these areas of these gray areas where some uncertainties is still hanging on. So if you can please move on to the next slide, Aaron. Okay, so what we're going to do for this is basically myself and Alvaro from Kinship. We thought it was very relevant also to have the perspective of someone from the finance industry. So we invited our friend Regis. Regis is a wealth planner with a long tradition. I mean, he was first in law firm, but then long ago he moved to private banks, to the most prestigious institutions, and he kindly accepted our invitation. And I think among the three of us, we're gonna be able to walk you through all these nuances of the regime. So this is the idea. First, we're gonna basically define what is a quasi-territorial tax regime. We thought it would be convenient to call it this way. I mean, the regimes have different names, of course, in different jurisdictions: non-dom, forfeit, lump sum payments, non-habitual residence, but they all boil down to the same key structural feature, that they tend to tax only or mainly or primarily income and assets sourced and located in the territory of residency and not on a worldwide basis. And that is what defines this regime, and that's why we're calling them quasi-territorial tax regimes. Alvaro and Regis will take us through the history of our regime, which is fairly old, although the last change that we're going to comment is to our view what is really at stake today in this conference. We will then dive into our regime, trying to identify aspects of novelty and concerns, cases which indicate where we believe controversy can arise in the future, and that will lead us to a few case studies, which I think will be very useful to help in that dynamic of understanding the potential areas of controversy. Okay, next slide, Aaron, please. Okay, so Alvaro, please, why don't you take us through what a QTR in your nomenclature means?
Thank you. So before we define what a quasi-territorial tax regime is, we thought it would be convenient just to take one step back and talk about the different systems for taxation that there are for individuals worldwide. In order of preference by taxpayers themselves, I would say the first one would be no tax, which is only left in certain countries in the Middle East. Then we would have territorial systems of taxation, which are mainly found in the Caribbean, Central America, Asia, and small jurisdictions. Then we would go to our systems in the OECD and the European Union, which are a combination of territorial and worldwide basis of taxation, territorial for those who are non-residents, worldwide basis for those who are residents. And finally, last but not least, we have the US, where they tax their citizens on a worldwide basis, regardless of where they live since the end of the Civil War in the US. So quasi-territorial tax regimes only make sense in the third category that I've described, which is by far the most common. And it is a regime, a preferential regime, which is designed to attract certain categories of people to the country. So basically, instead of being taxed on a worldwide basis because they became residents, they're taxed on a quasi-worldwide basis. Now, how that works depends on each particular country, but that would be the general definition of what we're going to target today. And these regimes can be targeted to different types of individuals. They can be targeted to high net worth individuals. They can be targeted to highly skilled workers, digital nomads, entrepreneurs, pensioners. It really depends. It's on a country by country. In our case, I think we now have all of them. So all of them can potentially benefit from our quasi-territorial tax regime. And today we're going to focus mostly on high net worth individuals, which is one of the novelties that just came into effect as of January 1st this year. So we can please move on to the next slide. So before we go into the specifics, we thought it would be convenient to go through a little bit of history. I think clearly different countries have based their systems in comparison to the UK and Switzerland. The UK pretty much started with a quasi-territorial tax regime themselves through their income tax, the non-dom status, which is based upon remittance. And the Swiss have a very particular system, which is not based even on income, but on expenditure. So the level of tax is defined depending on how much you spend in the country. So that is what we had pre the 20th century. And now we're going to go through the different changes. Regis will talk about the Spanish regime and the changes, and I'll try to add the novelties in other countries around us. So please, Regis.
Thank you very much, Alvaro. Hi, everyone. Yes, well, the regime was introduced in Spain, was approved in 2003, and it entered into force in 2004. Finally, it was a kind of very new tax regime approved by the conservatives in this moment. And it was, mainly it is known as the Beckham law or Beckham regime, because it was at the same time that David Beckham was hired by Real Madrid, one of the Galactics in the team. He was hired by 25 million plus 10 in bonus, and nothing to pay considering the tax regime applicable at this moment. So it was nothing very relevant for David himself, but very relevant for Real Madrid, because you know that they agree a kind of net of taxes amount. But it is definitely a territorial taxation based on source of income, and it was really interesting to attract highly qualified workers and executives. Next one, please.
So unlike Spain, Portugal did not seek to attract football players. They were never in the list of eligible individuals for the non-habitual resident in Portugal, which has been one of the most successful regimes so far. I just had a conversation with one of our colleagues in Portugal, and he told me that they may be nearly the 100,000 applicants already, which is quite a relevant figure. This regime in particular is very well designed, as most of you probably already know, and it's territorial taxation, but based on the jurisdiction to tax and double tax treated. Quite technical in its configuration. Let's move on.
Yeah, well, yes, in 2010, and now with the left party in the government in Spain, a kind of ceiling of 600,000 euros was introduced as a cap employment income for those eligible for the regime. Basically, it was explained as a kind of well, fair reasons in terms of doing it not applicable to ultra high or high payments or income in this kind of regimes. That was the main reason behind that.
Mm-hmm.
Well, in 2015, footballers and other professional leagues were finally excluded of the regime. So at the end of the day, this ceiling was removed as a kind of requirement that was needed to enjoy the tax regime. And then there was a kind of extension of the regime applicable to directors of a non-controlled Spanish entity, and this the ownership percentage of this kind of entity was less than 25%, which is still applicable, but with very recent amendments that have been, well, is a kind of they approve a kind of measure very recently to do it in a softer way.
Mm-hmm.
In 2017, the Italians came in with their imposta sostitutiva, which has proved to be very successful amongst the ultra high net worth for two reasons mainly. One is that it is a fixed tax, which is very easy to understand, 100,000 on any foreign income, of course, as always, with nuances. And they get the chance to get an advanced tax ruling, which gives certainty, which is something that ultra high net worth individuals value very much. The latest news that we wanted to share on the international context is that we have a very recent paper from the European Parliament. It is actually as recent as March this year, where one of the commissions of the European Parliament has submitted to the European Parliament itself a report where they suggest that these type of regimes should be eliminated within the single market, because they do create a distortion in the sense that they promote movement of people simply for tax reasons. And what they suggest is that special quasi-territorial tax regimes are suppressed within the European Union, and that capital gains tax is harmonized. Of course, this is just at a very early stage. It hasn't yet been heard in the European Parliament, so it is very soon to say whether the different countries, the different member states will agree on principle. We do know that there is a plenary sitting scheduled for June 2023, and we will then have Parliament's vote. So we will just have to keep an eye on this and see how it evolves.
And finally, and before all this possible harmonization in the European Union, you need to know that there are many attractive tax regimes in the southern Europe. I would mention Portugal, I mention Italy, Spain, and well, the UK and Switzerland always. But in 2023, the Spanish government approved a kind of let's say soft requirements to be able to enjoy this regime for the regime to be applicable, especially to investors, entrepreneurs, digital nomads, and their families. So it is now much more attractive than before, and I would say that requirements to be complied are much softer than the requirements in the past. So in conjunction with all the golden visa regimes we have in all these countries, I would say that the measures to attract talent to all these regions is clearly increasing.
Okay. Right. So the requirements that there are several requirements to qualify for the regime. As Alvaro said at the beginning, we want to focus primarily on high net worth individuals, and in the past, some of them came with employment contracts for entities in which they didn't have a 25% stake, which is the threshold above which an entity is deemed to be a related party with the individual, and that was the negative requirement that was in the regime. You couldn't work for a company with which you had a related party relationship as defined in the tax system. That is the fundamental change. Now, the regime, in the title of the regime, it has been widened to include investors. However, in the requirements themselves, there is no reference to investment whatsoever. The only related difference, reference comes from the in that particular point. It says any individual who comes to Spain as a result of that individual having acquired the condition or having been appointed as director of a Spanish entity. It says of an entity. We understand that it ought to be a Spanish entity. It could be a foreign entity, but typically it would be a Spanish entity. So we have investors in the title, and we have appointment as a director of an entity in the substance, in the regulation itself. And we believe, of course, they are connected. So typically we would see foreign individuals coming to invest in Spain. Investing through a company is so standard that it's not going to be motivated by having access to the regime. Most investments are made through company when they are significant. Now, the company can be a company engaged in an active trade or business, or it could be a mere passive holding company, asset holding company. That difference is relevant, because if the company does not conduct a trade, a business or a trade, then the individual cannot be a related party to the company. Okay, it has to have a stake, a shareholding of less than 25%. Otherwise, it wouldn't be eligible for the tax regime. That is very important. So if the investment is going to be in a business or trade, there is no limitation to the relationship between the individual and the company, and the individual can have a controlling, or it can be even the single shareholder of the company. Whereas if the company is mere asset holding, the relationship has to be, as I indicate here, below 25%. Okay. Now, if the individual comes, invest, there is a business, he becomes the sole director or a joint director or a member of the board of the company, is that sufficient for the eligibility for this test to be met? And as we will develop further on in the presentation in our illustrative cases, we believe that this cause-effect relationship may be one of the areas of controversy in the future, because one needs to understand that Spanish company law does not require individuals to be resident in Spain for them to be directors. So there is not a legal causation requirement between being director of a company and coming to live into Spain. But still, the regime says that you have to come to live to Spain as a result, or take residence in Spain as a result of being appointed as director. Now, any directorship and any activity is sufficient, or has it got to be relevant to the facts and circumstances of the individual? Does the directorship have to require have to be of a degree that requires the presence in Spain to discharge the duties of that individual being the director of the entity. That is what is at stake in this what we call cause-effect relationship between director and coming to live to Spain. Our recommendation, of course, is to take a prudent approach here, and we believe, and we will see later, that the administration of the company, to being a director of the company, must have the sufficient substance so as to make it clear that that is the reason of coming to Spain. That we believe is going to be one of the main points of contentions in the future and conversation. The next, please. Next requirement, Alvaro. How do you deal with this one?
Yes. So this is by far less relevant than the previous one. The regime does require that the individual has not been tax resident in Spain in the prior 5-year period, which before used to be 10 years. So that is a new element of the regime. It's been amended, and it's now more beneficial, just 5 years instead of 10. There's also been an amendment to clarify that the individual can come in the prior year, and that does not count as a year of residency within this 5-year period, because it has to be tax residence. Let's move on. There is a hard deadline. This is more of a practical thing to bear in mind. There is a hard deadline to request a regime, and that deadline is 6 months as of the date of the appointment as director, if that's the case. And there is no need to register in the Social Security. If there is need to register in Social Security, then as of the date of enrollment. As I said, just a practical thing to bear in mind. If the election is done after that date, the regime is no longer available.
And the fourth is basically this has been in the system from the outset, from the first introduction of the regime, is a negative requirement, a negative covenant. It's basically the individual must not perform an activity in Spain that, had he or she been a non-resident of Spain, that activity would be deemed to be an economic activity carried out in the Spanish territory through a permanent establishment. It's a convoluted way of expressing, we believe, what is, look, this is not available for independent professionals and entrepreneurs who conduct a trade or a professional activity independently for their own account. That is clear. The system never, the regime never accepted those that profile of individuals, possibly out of wishing not to introduce too much of a distortion in a competitive market in the professional arena, so that's been from the outset. We will see in one of the cases that we will review later that this opens up an area of potential controversy in today's world, where remote work has been accelerated and enhanced recently. Basically, what about those individuals, professionals, independent professionals who come to Spain and realize all of their trade and professional activity abroad through telematic means, remotely? Is that a permanent establishment in Spain if they do that from home, from their computer? We will see that later, but we think there is room for discussion and opportunities around this requirement and concept. Okay, next one, Alvaro.
Yeah, sorry, lost connection there. So the last requirement is that whatever was the cost for the individual to be eligible for the regime should be maintained whilst the regime is applicable. And there's been a little bit of leeway from the tax authorities in the sense that they allow a change whilst the individual is present in Spanish territory, as long as that change is also within the list of eligible positions. So there could be a change of employment contract or directorship.
Very good.
Okay, so now we have the main features. This is also relevant. This is also new with the new regulation. Before, only the taxpayer who was eligible for the regime could qualify, not the relatives. Now the relatives can also qualify for the regime. And there is a small nuance here, because amongst the requirements that the spouse, which is the main case, have to qualify together with the main applicant, is that he or she cannot obtain more Spanish-sourced passive income and worldwide employment income than the main applicant, but it does not make any reference to foreign sourced passive income. So it may well be that the main applicant is the active one who comes here, for example, with unemployment, and the spouse who has the wealth can also benefit from the regime and is not immediately excluded because of these requirements, something which we also have to look into.
And this is a new requirement, right, Alvaro? I mean, all about the, okay. Yeah, applicable since 2023. On the well, you see that the requirements are really demanding for this regime. I mean, it is a kind of you know the requirements are more flexible than in the past, but it is still demanding. But the tax benefits are really attractive. In the income tax side, I would say that well, the only category or income to be taxed in Spain is about salary and professional activity income, which is taxed at 24% tax rate up to 600,000 euros, and then 47 flat tax rates on any excess considering this amount. And this is including worldwide salary or worldwide professional activity income, not just income coming from a Spanish source. Then, well, foreign taxes paid on employment income may be credited, but limited to 30% of the tax due in Spain, which is important. On the other hand, and this is a very attractive one, any other income is only taxed in Spain if sourced in Spain. So if not sourced in Spain, it's not taxed at all. And then it is a kind of progressive tax rate ranging from 19 to 28. 28 is on any excess of 300,000 euros. On the other hand, and this is attractive too, you know that in Spain we have a kind of wealth tax which is regional, and then in 2022 and 23 a kind of solidarity tax, which is essentially the same as a wealth tax, but this one is from the central government. So there is no double taxation, because you can deduct the central one from the regional one, but the marginal rate is 3.5%, and this tax is only applicable on Spanish situs assets, and we will see about them in the next slides. Only to Spanish situs assets, not to any other assets held abroad. So this is very relevant. On the other hand, and this is important too, inheritance and gift tax are taxed worldwide. So there is no protection under this special tax regime for inheritance tax. For this reason, both, I mean, wealth tax and inheritance tax, but even income tax, it is especially relevant to consider when someone is thinking on moving to Spain and applying or trying to enjoy this tax regime. It is very important to think about the place of residency. It is not the same Madrid or Andalusia, where you have a kind of 99% exemption on inheritance and gift tax, for instance, or 100 exemption on wealth tax in Madrid, and other regions as the Balearic Islands, as Catalonia, as the Basque Country, or any other. So this is a first thing to do carefully before moving to Spain. On the other hand, the ownership structure is very relevant. It is not the same. I mean, you need to validate your existing structure. I mean, not all these structures are valid or efficient from a tax perspective. They may be efficient while you are enjoying this tax regime, but maybe not in the future. And in case this tax regime could be challenged, the ownership structure should be taken into consideration just to be double protected. So trusts, for instance, are not always recognized, and they could be considered as a kind of look-through entities in many cases. And finally, products are, investment assets are really important too. I mean, it's not the same to invest in European mutual funds with, tax deferral regimes applicable than on any other kind of, private equity investments, direct investments in stocks, in fixed income or whatever. So if you are looking for this double protection, you will have to take care of what kind of investments are you doing. Next slide, please.
Okay, well, this is contentious. As we all know, double tax treaties apply to residents of a country who derive income from the other country, source in the other country, and the treaty themselves. All those who follow the OECD model define residents of a country by reference to the domestic provisions, to the domestic laws of that country, but treaties contain an addition, which is basically that those who are domiciled or have their main residence in that country, but are subject to tax only on a territorial basis, on assets or on income sourced from that territory, are not entitled to the treaty, which is in an essence is logical, because in the first instance they wouldn't have the double taxation issue, because they're not going to be taxed on income arising from the treaty partner, from the other territory. So with that in mind, if our regime is qualified as purely territorial, it wouldn't have access to the treaties entered into by Spain. That is clear. But we say in principle there, and we don't, we think this admits a very relevant nuance, because employment income is subject on a worldwide basis. So at least for employment realized abroad in the other territory, in the circumstances in which that employment could be taxable in the other country, it wouldn't make sense to deny treaty benefits, treaty relief to that income. And of course, if the individual resident in Spain has dividends or any other income from capital sourced in the other country and is not taxable in Spain, it would be fair not to impose the other country, not to demand the other country to grant relief, exemption of reduced withholding rate on that particular item of income. It makes sense. This issue becomes particularly relevant and contentious for those individuals who emigrate from their country of origin and want to come to live to Spain, but they retain assets or significant economic connections with their country of origin, and they would like to come to Spain and break ties with their country. But if they still resident in their country of origin by way of these other criteria than permanence, but by day counting, the extent to which the tiebreaker provision of double tax treaties can be claimed to attract or to break the tie in favor of Spain is controversial. If that individual cannot apply the Spanish treaty, can he still apply the tiebreaker rule? Only if he or she is going to derive employment income from the other country, which is going to be taxable in Spain. And this is basically the point we wanted to make here. This is particularly relevant when income from capital is taxed heavily at source by way of high withholding taxes. We make reference here to the US. We know the US is a high withholding tax country for dividends and interest. If the recipient is resident in Spain and not taxable because he or she qualifies for the regime, possibly the US is not going to waive that withholding under the treaty, particularly because the Spanish authorities are likely to give a certificate of tax residency, which is going to be relevant for the withholding agent to apply the treaty benefit. So let's keep a close eye on this particular point, which may be very relevant in practice. And the last one that is very consistent with the regime, as income and assets, income from foreign assets and foreign assets themselves for wealth tax are not taxable. It makes sense not to have to report them on our disclosure forms 720 period. Okay, that's pretty straightforward. So next slide, please.
Okay, what are the connection factors? This is very relevant considering that you have to think about income sourced in Spain or assets located or sites in Spain to see and analyze any possible taxation, local taxation in Spain. So what are, for income purposes, what are considered as income in Spain? Well, basically, and in summary, income coming from any issuer or payer located in Spain is going to be considered as income in Spain. So income subject this to taxation here. There is let's say I would like to point out here capital gains, especially related to real estates, because, well, in this case, if you own directly real estate which is located in Spain, essentially capital gain will be levied in Spain. But if what you own is a company which is not resident in Spain, but their main assets are located in Spain, I mean more than 50% of the assets of the company are real estate in Spain, then even the transfer capital gains on the transfer of these shares will be levied in Spain. On the other hand, and considering the wealth tax, which is very relevant, as mentioned before, the criteria is similar. I would say that the main general criteria set up in the wealth tax law is that any asset or right situated in Spain or that can be executed or exercised in Spain or have to be fulfilled in Spain is going to be levied in Spain and considered a kind of Spanish citrus asset. Having said that, our tax authorities have been issuing several criteria, and essentially what they understand is that if the asset is coming from an issuer or is custodied or deposited in a Spanish entity, then it will be considered a Spanish citrus asset. There is a very specific mention here about a concrete binding resolution issued about investment funds, which is, let's say, a kind of very unique and particular criteria in the sense that it is considering Spain and Sweden. There is a double tax treaty covering inheritance tax between both countries, and Spain only has 3 tax treaties with 3 different countries about this area. And the criteria is not exactly the one described before, but it is about the place where the units of the fund or participations on the fund are registered in the name of the last beneficial owner. Well, this is not the general criteria. The general criteria is about the issuer or custodian depository, but this is something to take into consideration. Again, to try to be double protected, and just in case any of the requirements are not could be challenged, let's say, by the Spanish tax authorities, some owning or ownership structures could be, let's say, recommendable just to be double protected in Spain. Essentially, that's the main idea. Considering wealth tax and considering inheritance tax for sure, and then personal income tax. So any possible tax deferral vehicle that could be incorporated before moving to Spain could be an interesting option always to be considered. And again, to analyze carefully the place to reside in Spain is always an additional very relevant point.
Next slide.
Next slide, please. Yes, thank you.
Okie dokie. So these are the, we have 20 minutes left, and we're gonna leave some space for Q&A at the end, but we wanted first to, with 4 cases, illustrate what we believe maybe circumstances that the new regime, the enlarged, the widened scope allows for, that they were not permitted in before the end of this year, before the beginning of this year, so 22 prior. But we will have to explore the meaning of this cause-effect relationship we dealt with as the first requirement. So a case which is coming to our attention is increasingly is a high net worth individual with investments outside of Spain. We have seen this structure is typical of Latin high net worth families, and they are considering to come to live to Spain. The question is, if we hive down our companies underneath a Spanish holding company, and I become a director of the Spanish holding company, am I meeting the requirement? I mean, who's going to tell that? Who's going to say that individual, if the individual is saying, I come to Spain to manage my holding company because I am a director of that holding company, is that sufficient, the representation by my individual, or will the authorities be entitled, any third party judge will be entitled to, given the circumstances, determine whether the requirements, the administration, the management requirements on site of being a director of that company are sufficiently important so as to make that person take the decision of coming to live to Spain. Does the equation change if the Spanish holding company, besides holding what was already controlled by the individual, makes further new investments in Spain or elsewhere? We believe, I mean, there are merits to for that individual to qualify under the regime, but the more the substance, the more new investments out of the Spanish holding company, the easier it will be to defend that it is the administration of this company which has caused the individual to come to live to Spain. But I'm sure you appreciate the nuances here and the potential area and room for discussion.
This is very interesting. This is very interesting, and again, I think that it is very linked and related to the substance of the Spanish holding company and the business rationale behind this movement. I mean, it is not all about or a, let's say, unique reason, could not be a tax reason. As far as this is responding to any other kind of business rationale or reasons, it could be, you know, more defended in a let's say stronger way. On the other hand, and once you're mentioning Spanish holding companies, I would say that this kind of, let's say, contributions in kinds or exchange of shares may be protected in Spain. So these kind of movements could be additionally protected by a tax neutral regime applicable to all these kind of restructuring transactions. And additionally, and complying with several requirements, there is a kind of participation exemption regime in Spain that is potentially applicable, and is basically a kind of exemption on dividends and capital gains obtained by the Spanish holding company coming from Colombia or Ecuador, in this case, by applying this participation exemption regime. Additionally, other kind of tax benefits as a family-owned business benefits could be potentially applicable in this case by complying additional requirements, but is perfectly possible and feasible, and is about exemption on wealth tax and 95% exemption on inheritance and gift tax as well for this kind of family-owned business schemes, just to point out about
Thank
this.
You. Sure. In the next case, please, Aaron, in the next case, as you see, The point we want to make here is, I mean, in this case, the individual is not contributing to a Spanish holding company for whatever reason. Mainly, the individual wants to initiate a new trade in Spain, but the new trade requires an investment which is insignificant, or let's say it's not significant relative to his or her entire wealth. Do we have to go into this relevance test to answer the question of whether that activity on its own, that activity per se, is the reason for that, the motive, the cause for that individual to come to live into Spain? Of course, there is no reference to that in the regulations. There is no objective test of when the investment is deemed to be relevant for these purposes. And we will have to rely on our good judgment and, of course, risk-averse individuals and families will want to increase the 1 million versus the 199. Perhaps the extreme case here serves to make the point, but we would like, right, Alvaro, to have this individual conducting something more relevant in Spain to be sure that he or she can safely purport that the reason for coming to Spain is to manage that investment.
This is actually quite a fair common question that we get from ultra high net worth individuals, where they just consider buying a small hotel or starting buying a restaurant. And of course, the bigger the wealth, the more complicated the question on whether there is a cause-effect relationship between the appointment as a director in a small hotel and the movement to Spain.
Absolutely.
Well, even the criteria of tax residency in these cases about economic center and vital center of interest could be potentially challenged. So this is extremely important in my view.
Correct. So next slide, please. Okay, here we want to illustrate, and this is happening. So that we're seeing cases of business owners still at the top of the management of their groups, of their control groups, with operations worldwide, but without operations into Spain. Now, the group is going to start operations into Spain, sometimes very significant, some other times just exploratory initiatives, market research, understanding the market, and the person on the top, on the control of the group, takes directorship of the Spanish company and comes to live to Spain. Today, this is enabled more easily by the ability to carry on managing the group and working remotely. We'll put aside the perennial issue of place of management and control, and whether the individual coming to live to Spain and controlling or managing the group remotely from Spain creates residency issues for the group itself. We put that aside, but from the point of view of the regime, how relevant is it that that individual is actually and in substance connected with the activity that the Spanish subsidiary is going to be developing, unfolding? How relevant that activity has to be for the entire group? We launch here a message of prudence. Also, we believe that not any activity realized in Spain by the Spanish subsidiary would qualify for the individual taking directorship here, coming to live in Spain under the regime. I'm sure, Regis and Alvaro, that you share my views here.
Absolutely.
Okay. And the last case study before we open the Q&A, or we review whatever aspects you feel appropriate, has to do with a question that is coming more and more often. This is more than, sometimes they are high net worth, but very often they are successful skilled workers, and they are in professional environments, asset management, law firms, consultancy, architects, and they work in big companies, typically in partnerships. They hold interest in their partnerships, but they are wide groups, they're big groups, so their interests are never substantial, but they still derive in their home country income from partnerships, and sometimes they are not employees under the local regulations. Would they be employees under the Spanish regulations or not? Or will they maintain in Spain their status of professional independent professional income earners? And that's a relevant point, because let's not forget that negative requirement we discussed at the beginning of the presentation. Spain does not allow to benefit from the regime to those individuals who develop in Spain an activity which would be deemed to be a professional activity or economic activity through a permanent establishment if that individual was not resident in Spain. So that the question comes there: if that individual comes to Spain and he or she can work for his partnership or for his company remotely from home with a computer, but without accessing the Spanish market, without having an active trade or business in Spain for the Spanish market, is that a permanent establishment? I have serious doubts. We know that the question of the permanent establishment and the remote work has been very controversial. The COVID lockdowns and the hybrid work from there has exacerbated this question, and it's very high on the agenda. We are starting to see some clarity on when companies are deemed to have permanent establishment in other territories, when some of their employees or top employees go to that country to work remotely for the company. Typically, it is required that the company puts table means a presence available to the individual on a permanent basis for the company to be deemed to have a permanent establishment. But what if it's the individual? If it's his home or her home, the company is not going to be deemed to have a permanent establishment, but the individual has professional income because he or she doesn't have a labor relationship, an employment relationship, but he's a partner of the partnership of the company. Is his or her home a permanent establishment for his or her professional activity? That is the point we wanted to make here. I believe there is room to say that that is not a permanent establishment, and this is a question we're getting from independent lawyers and consultants, asset managers who provide professional services to non-Spanish people, to non-Spanish operators, and they do it remotely from their home in Spain with their computer. Are they entitled or not? We will see. We will see. Okay.
I mean, clearly the position of the Spanish tax authorities at the moment, and I'm going to focus on the partners at the law firm, since I know that's the majority of the audience we have today, and I'm sure some of them would love to move to Spain. The current position is that a partner in a law firm is not entitled to access this regime, but there is, as Pedro said, room for argument because the law is described in such a convoluted way that it is somehow unclear.
Okay, but just to be clear here, Alvaro, if a partner of a law firm comes to Spain and work remotely for the foreign partnership, and there is no business in Spain, if that is all, he or she is not entitled because there is not any of the requirements. But what if that person, in addition to carrying on being a partner, does a separate trade with a single-owned company and becomes a director of that company? So that would bring him into the Spanish net and the possibility of applying the regime. The question is whether he or she would be failing to comply with the negative requirement. And is working remotely from home a permanent establishment of him as a partner? I would doubt it.
The latest binding rulings that we have from the tax office just cut through this and equate that requirement to income from professional activities. But it is not what the law states. So that's where the nuance is, of course.
Okay, good.
We have 5 minutes left.
Yep. And this is what we wanted to share with the audience. Aaron, I don't know if the Q&A is open now, or is it?
We can move to the Q&A now. We have 5 minutes or so. I don't know if you've seen, Pedro, we've had a few questions that have come in from the audience. Just before we move to the Q&A, I want to say thank you very much to our panel for their expertise today. It's a really fascinating discussion and a really important topic, I think. If anybody in our audience does have a question though, please do send it in now. We will have time to answer it. We had a question in from Indrani, which came in before the webinar, and they just simply ask, and I don't know if you can expand on this, is a person who has Spanish citizenship but they're living outside Spain eligible?
Yes, the answer is yes. Citizenship does not bear any effect here. The only point is that that person has not had tax residency in Spain in any of the preceding 5 years. That's the related to citizenship residency. That's their requirement. Okay.
Thank you. And I would encourage you to get in touch with the panel if you want to discuss in any more detail those requirements to make sure that you do comply with those. There's a question in from Peter. I'm based in Canada and interested in having a second home in Spain. Is there anything that I need to be aware of or anything that I need to put in place for that?
Alvaro, you want to take that one?
I mean, it's unrelated to the special tax regime, the question, but yeah, I mean, happy to talk about it separately. I think is for.
Basically not. I mean, if you're going to remain resident in Canada, not an issue. If you're going to live here, so watch out the days. Count the days that you use your second home. Spain is very attractive. So if you exceed the day count and you stop being resident in Canada, you may fall under our tax net. Okay.
Excellent. I think that's a great answer. And as Alvaro says, definitely something to speak about after the webinar as well. So please do get in touch. Whilst we're waiting on any further questions that come in from the audience, I would just like to ask Pedro or Alvaro or Regis if you have any sort of key takeaways that you want our audience to leave the session with today in the next sort of 3 minutes, if you can give us those.
Yes, if I may, Regis, Alvaro, the main takeaway is high net worth individuals can now come to Spain to the extent that they invest in the Spanish business with certain relevance. Okay, if they manage that business by becoming the director of the company, and the substance of the business is such that it makes sense for that individual to come to Spain to manage the business, this is open. What Regis said about inheritance tax, it is important. Inheritance tax is not covered by the regime, but it's also important to take note that our inheritance tax applies to recipients, not to donors. So if the individual who is coming to Spain is of the older generation, of the person with the wealth and not the person expecting to receive the wealth and inheritance, that shouldn't be an issue. The fact that the regime does not extend to inheritance tax shouldn't be an issue. Okay, proper planning is always significant and advisable, not only because people, when they come to Spain, the regime applies for 5 years, and it's not the first. It wouldn't be the first case that falls in love with Spain and wants to remain longer. So if we can prepare sooner rather than later for the after regime, better. And also, just in case there's some controversy and some fallback, it's good to have your wealth organized as if you were an ordinary resident, not eligible for the regime. That's always an advice that, to the extent possible, should be followed. Regis, you want to add something to that?
No, this is a perfect summary of everything. And again, if possible, double protection is always recommendable. I mean, not just applying for the special tax regime, but even thinking on ownership structures protecting you just in case this scheme or structure would be challenged by the tax authority. So I would say that is very relevant.
Brilliant. Thank you. Thank you very much for that. We've just had a few questions come in, and I'm aware of the time, but I think we can go a few minutes over to take some of these questions. I don't know, Alvaro, if you've seen those questions in the chat.
Yeah,
and if there's...
I think we would share. I would share the last one, which is the most complicated one for the panel.
Okay.
Could you further explore the sensitive issue of management and control and permanent establishment, and how this could have a negative effect on a relocation plan to Spain?
Thank you, Alvaro.
Thank
Okay,
you for that
so
question.
if the individual who is coming to live in Spain is one of the key persons of the foreign group, of the foreign enterprise, and it could be said that that person is actually managing the foreign company out of his or her home in Spain, of a Spanish territory, there is clearly a risk of attraction of residency of that entity to Spain. I mean, this is particularly relevant in cases where the individual is, when the company is a solo man company, it's a professional individual, or is a businessman who does everything through a company. He's the sole player and he comes to live in Spain. Then that situation is extreme. The permanent establishment issue is a bit more awkward, I would say, because if that individual comes to Spain, if he or she is part of a wider organization that is not going to do business in Spain, and the individual is coming to Spain to work remotely, it is clearer that that situation does not create a permanent establishment for the foreign enterprise. Although it's something, of course, nuances and facts and circumstances are extremely important here. But those are the main 2 points that we need to be aware of and to monitor specifically in this cases and for this topic. Okay.
Thank you very much for that, Pedro. We will leave it there, but thank you once again to our panel for being with us and sharing their insights. We really appreciate it, and thank you to our audience for being with us today. Goodbye.
Bye-bye.
Thank you very much.
Thank you.
Bye.
Thank you, everyone.